All right, let's talk to Phil Palumbo. He's the founder, CEO, and CIO of Palumbo Wealth Management. Phil, do we have another leg down in this market? I'm just not sure how much I should really buy into this bounce off the bottom. What say you?
Well, you took the words out of my mouth, right? So we're still in the middle of the storm. And the way I look at it is the Fed said that inflation was going to be transitory. We were the furthest thing from transitory. The Fed says that we're not in a recession. We had 2 back-to-back quarters of negative GDP. As long as I've been doing that, it's always been the definition. I totally get the tight labor market, so technically probably we're not in a recession now, but everything the Fed is doing and is embarking on, right, all of that still needs to be absorbed into the economy, and it takes time. It takes 6 months. It could take a year. It could take a year and a half. So at some point, this data will continue to worsen. When you think about PwC survey, 50% of firms said they're anticipating layoffs. The inverted yield curve, sentiment again is high. You look at the multiples on Amazon and Apple. Forward on Amazon is 56, Apple's 26 times, and both have grown revenue 1.87%, another one at 7%. So valuations still have to come in, and there is going to be another leg down that will retest the lows that we saw back in June.
But what's the driver of that retesting of the lows? Is it the Fed hike? Is it recession worries? Is it a slowdown in consumption? I mean, I'm admittedly at fault here because I'm a journalist and I was repeatedly told by traders not everything has a fundamental narrative. But why do you sell out of this market when capital flows from other countries and really the rest of the world could actually provide some sort of support?
Not everything has a fundamental narrative if you're a trader in the short term, but over the 6-12-month period, which is a long-term period, with everything that the Fed is doing, and because we're in a tight labor market, it means inflation could be more persistent, which means the Fed has to act even more aggressively or continue to be aggressive, and all of that is not a positive for stocks. And ultimately what happens is our companies, executives, they're making decisions to lay off. You're going to see analysts revise earnings. A revision of earnings of 10 to 20% off of what the 2023 250 prediction is, that brings you at a forward multiple today of 19 to 22 times, which is basically where we were in the middle of January. So that's not attractive thinking about what the Fed is embarking on and how inflation could be sticky.
So, Phil, what do you tell your clients about, given that backdrop, your call there for equities? I mean, I see in the first half of the year, the terrible underperformance of fixed income across the board, whether it's corporates or treasuries, investment grade, high yield. There's nowhere to hide. So if we've got another leg down here, what are you telling your clients these days in terms of if they have some new money to put to work, maybe?
Well, a couple of things, right? So I've been very consistent, whether it's on your show or anywhere else, that we were in a tech bubble that burst. We thought the stock market as a whole was in a bubble. Right, that came down 23% peak to trough.
Yep.
The technology got killed as well. So coming into this year, we were aggressive in cash, and we still are today.
Right.
So we're being very patient. Like Buffett says all the time, wait for the perfect pitch. We're not at a situation where we're having a perfect pitch right now. So we're being completely patient in this scenario. We had great returns. Everybody did, right?
Yeah.
Going 19, 20, and 21. So being patient here in 22 with everything going on is perfectly fine thing to do.
I've got to say, I'm curious, though, what else you put your money in. I mean, if you're pulling out of stocks and let's say going to cash, for example, does that mean money markets? Does that mean just buying the dollar straight out? Where does that money go?
Yeah, for us, we put it in money markets that can yield between 1% and 2%. It's not a great return, especially when you factor in inflation. Completely get that. But if we do get a great pitch thrown at us, and it's a good time to put capital to work where we can make great returns over a 3 to 5 year period, then that could happen over the next 2 to 3 months. So even though the return in cash is not great, it's the opportunity that we're looking for that we believe will occur that will make up for any type of low return you're getting in cash today. We also are investing in gold. We're also in commodities as a diversified, balanced portfolio, and obviously we have some exposure to equities as well.
How do your clients, Phil, do they ask you about crypto, Bitcoin specifically? And if so, what do you tell them?
Yeah, the answer is just like I think of growth stocks, right? So when you're investing in growth stocks, you try to make a prediction of how much a product is going to be sold with that company over a long period of time. And that prediction is just so speculative, right? So when you think about like Bitcoin and Ethereum and others, you're talking about something that is complete speculation.
Yep.
So why would I invest my clients' hard-earned capital in something that is speculative? Yeah, it could turn out great, but also could turn out terrible, right? So when it comes to investing, I really believe it's about risk and return profile. So I'd rather buy a great company like McDonald's or Coca-Cola or Pfizer, have free cash flow yields of north of 6-7% or 8% or more than that,
Yep.
which is 2 to 3 times the 10-year Treasury, with stable earnings, great management, great economic moat. For me, that's how you invest capital,
Gotcha.
and over the long term, you'll succeed.
All right, Phil, always great to get your thoughts, your perspective. You've been in this game a long time. We always appreciate your experience. Phil Palumbo, founder, CEO, and CIO of Palumbo Wealth Management there.